Hey everyone, welcome to the KE Report Daily Editorial on Tuesday, October 21st. Chatting with Dave Erfle. Dave is the founder and editor of the Junior Miner Junky. As we always do with Dave, week in, week out, we'll look at the precious metals market. And boy, oh boy, do we have a lot to talk about right now, Dave, as precious metals are going through a correction. Last Friday, we saw huge volatility, down day for gold and silver, but then a nice rebound on Monday. Today, though, wow, gold is down over $200, about $235. Silver down almost $3.50. These corrections are coming pretty much from all time highs. And in all fairness, look, we do see the biggest down days in bull markets and the largest up days in bear markets. Everyone's been waiting for this correction. Now it's here. The stocks are following the metals down. This brings up the big question, Dave, of just how long is this going to go? What are the opportunities? Or is this a top in the precious metals? No one has those answers. Don't listen to anyone who claims to have those answers. But I'm curious to see how you're viewing this correction and this volatility.
Yeah, Corey. Well, it's an interim top for sure. Yeah, we've been talking about it for the last few weeks that we've been expecting this, right? I mean, we had 3 weeks in a row in the miners reversal candles, three consecutive reversal candles, and then last Friday that huge bearish engulfing candle, right? Especially after previously both GDX and GDXJ closed above their weekly upper Bollinger Band for 6 consecutive weeks. So this was really expected, and the miners were telling you what was going to happen here. Especially last Friday was really interesting because we had that reversal in gold and silver wasn't so bad, but in the miners it was huge. And it happened on a day when the CME raised margin requirements on gold futures by 5.5% and on silver futures by 8.5%. So this was happening right after we had that backwardation in silver. So the CME's all right, saying, all right, we got to calm this down. And that's exactly what happened. Today we had gold's had a $300 reversal today. It hit 43.98 overnight yesterday, and it hit 4,093 this morning. So, when CME raises margin requirements like that, the speculative bulls get driven away when there's huge volatility, and boy, do we have huge volatility here. So, I warned my subscribers last week that, hey, we're probably due for at least a 20 or maybe even a 25% correction in the miners, and it looks like it's already started here.
Yeah, Dave, we got half of it today as far as that kind of percentages in some of these stocks. So it's been a doozy. But let me ask you a question about the kind of correction we're going to get here. I mean, again, nobody really knows, but when we think about the chart pattern we were talking about the last couple of years, which was that cup and handle pattern in gold, the arithmetic extension was around 3,500, the log extension was around 4,000. Mission accomplished. We had the exact projection we hoped to see play out. You check that box. Well, when a long-term chart pattern like that has the target achieved, what does that mean for, I guess it'd be an intermediate term correction. What does that mean for the duration of it? What does that mean? Any rules of thumb around what you expect to play out?
Yeah, I mean, like you said, I mean, we got what we expected, and it went even higher when, almost $2 below $400 higher than we expected when gold reached 43.98. So, I wouldn't be surprised to see gold quickly come down to at least test 4,000. That would be 39.50 to 4,000 would be a 10% correction, because we take a look at what the gold price has done ever since it broke out of that cup and handle pattern that you were referring to. It rises really sharply. It reaches an interim peak, and right before, remember, right when Trump was elected, it reached an interim peak too, and then it consolidated inside of a symmetrical triangle for about 4 months. Well, when it reached 3,500 exactly, it was an interim intraday peak, and the gold price consolidated within a nearly 5 month consolidated symmetrical bullish symmetrical triangle consolidation pattern. So there's major resistance now. The next major resistance level is 4,500. We came within $102 of that yesterday. So I wouldn't be surprised to see a long consolidation here after a sharp spike lower. So that spike lower, if it goes down to 4,000, like I said, it would be about a 10% correction. But if it goes down to where there's stronger support at 3,500, I think that would be about a 20% correction. So that's even possible. So those are the numbers to look out for here right now, I think.
What a gap in the charts we are seeing today, too. It'll be interesting to see if that gap, at least temporarily, gets filled. Look, because the stocks were on such a tear really from August through to the last couple days, gold went on a tear from September up until the last couple days. We're still way above those levels. But the one thing that really stands out to me, Dave, is the volume that has come into this sector, especially in the last few trading days, but also in the last couple months, reminiscent of the lows back in 2015 and maybe even the tops back in 2011. What do you think about the volume that we're seeing these sell-offs and this volatility trade off of?
Yeah, the volume spike on Friday was twice the size that we've seen recently, and the volume today looks like it's going to be probably just as high. So yeah, I mean it's not surprising because there's lots of buying and selling going on here after an interim peak is reached. And if you consider the fact that both GDX and GDXJ have more than doubled this year. And since August alone, the GDXJ was up 75% and the GDX was up 65% just in the last few months. So, a 20 to 25% correction would be natural here, and it could happen quickly. A 20% correction in the GDX would take it down to around 67, 68. And that's where it broke out above its all-time high. So coming back to test its all-time high at 67 would be natural here, especially after that 65% move in just a couple of months. And if you take a look at GDXJ, if it comes down to test 85, I think that is a 25% correction. So yeah, I mean that's just normal after such huge moves.
Well, Dave, I find this also to be strange timing in that we're just about to kick off earnings season with Newmont's earnings in a couple of days, and we'll have several weeks of a lot of the seniors and the mid-tier producers putting up what should be record Q3 numbers. And when people look at what the average quarterly price was in Q3, it's still going to be a lot lower on both silver and gold than where we're at today. I mean, I think the average quarterly cost is going to be around 35, 3,600 gold, maybe a little bit higher than that, maybe a little bit around 38, 39 for silver. So even if we see corrective moves in the metals, we're going to be getting these record earning reports when metals prices are still way higher and have been for the whole start to the fourth quarter. What do you make of the dichotomy and analysts trying to figure out forward valuations?
Yeah, that's a great question. We're about to see just how much of these fat margin profits are priced in. It's going to be kicked off on Thursday with Newmont. Newmont always kicks off earnings season. So it's after the close on Thursdays is what you want to look for. So, we could get that 20% correction even before their quarterly statement comes out. That wouldn't surprise me. So it's really, I guess, like you said, yeah, it's going to be interesting to see how much of that is priced in because some of it is priced in.
We will see. And the one thing, too, that we need to understand with earnings reports is that everyone then needs to forward project where the metals price is higher than where it ended Q3. But I truly believe we need this momentum to stay with the precious metals sector. And that means gold, silver, people being able to talk about all-time highs sooner rather than later again, because as much fast money has come into the sector, which undoubtedly it has, look at the stock charts, that money will also rotate out. That brings up a question of leadership, though, Dave, because what came out of summer, I think, really showed the leadership of the stocks, where gold did practically nothing for 4 to 5 months. And the stocks kept building. They kept moving higher. And then in August, the stocks started to move even higher. And then gold, silver, they really started moving in September. So the stocks showed some leadership. Are you looking for the stocks to show leadership in terms of when this correction might end?
Yes, they show leadership in both directions. Both gold and silver usually lead the gold price in both directions. So gold and silver last week started to show relative weakness at the end of the week. And lo and behold, look what happened here at the beginning of this week. So it's going to happen again on the other side to give us a hint when the gold correction is likely close to being over. Both silver and the miners will lead the way higher once before this correction has run its course. They'll give you the hint that, hey, the gold price is done with its consolidation and it's going to go higher. I have a feeling it's going to take a while here. Like I said, we're probably going to have more weakness really quickly here in the gold price, at least down to 4,000 and maybe even down to 3,500 within the next week or so. That could happen. I wouldn't be surprised because we've had that huge move with nary a short-term correction. The weakness was bought quickly. And we know as soon as we see rhino horns in this sector, we see fishing lines quickly follow. And that's what we're starting to see right now is fishing lines. But if you're looking to get into this sector and you missed a lot of these stocks that have made these rhino horn moves, we talked about taking profits on the way up. I've been talking about it for the last several weeks. I've been doing this and I've recommended other people to do this. You trim profits off your rhino horns. And then once you get that fishing line, if you're sitting around with cash, you see that fishing line sell off, then you start accumulating. Because in bull markets, you accumulate fishing lines. And if you accumulate a little too early, it's okay because the bull market generally bails you out. But if you try to accumulate fishing lines in bear markets, it takes a lot longer and you may end up selling for tax loss. So we're in a full-fledged bull market now in the mining sector. So this is the time to have your watch list ready and have some price targets to where you want to start nibbling.
Yeah, Dave, and you bring up an interesting point about in the past when people got run over, they took tax losses. We were joking that we weren't going to have a tax loss selling season. Maybe we still will on some of these names, but I want to bring up some news that we used to talk about on Mondays, and that's mining merger Mondays. And we saw some big news out from a large intermediate, IM Gold, picking up two different companies here, making a move on both Northern Superior and Mines Day or Orbeck. So you've got two companies are picking up in a attractive jurisdiction. IM Gold diversifying their overall portfolio mix and trying to grow from a large intermediate maybe to a larger major senior company. What do you make of double M&A action from Monday?
Yeah, it's fantastic, and it's basically the course that I've set it for myself and my subscribers to where we want to accumulate these companies with these huge land packages in these top tier jurisdictions, so eventually they could be bought out by a major or a mid tier. I mean, what IM Gold is doing here, it's consolidating land ownership around their Nelligan and their Monster Lake projects, which together hold 3 million indicated ounces and over 5 million inferred ounces now that they're adding to their portfolio. So, the optionality play that I added a few weeks ago, they have a huge land package in a tier one Canadian jurisdiction. And just this week, I added my first drill play to my portfolio in like 3 or 4 years. I think this is the time to take a chance on a drill play. And this drill play has a huge land package in a top tier jurisdiction, and they have two major gold companies that are strategic partners in the stock, and they've just cashed up. They're cashed up through next year, and they've got all these targets on this huge land package.
So, Dave, with the IM Gold acquisitions here, does it open up other projects or other companies in your eyes in and around where the current acquisitions just happened?
Certainly. Yeah. I mean, it does. I mean, you want to look at area plays, especially, like I said, companies that have these really nice land packages. Either they have a defined resource, they've just issued a PEA, or they're about to issue a PEA, or even if they're a drill play. But, those drill plays are super high risk. And I haven't, like I said, I haven't touched them in about 2 or 3 years. But now it's time, I feel, because you've got into these companies already. You've got into a few optionality plays, or you've got into a few late stage companies, and you've done really well. You've trimmed some profits, and you've also trimmed some of your investment capital in the form of large profits. What are you going to do with that money? Well, why not take a chance on a drill play that has those attributes that I just mentioned?
Well, Dave, I want to go into the development stage companies because we've talked a little bit about what the producer's margins are going to be like. We talked about the early stage companies now being the time. But it should be the time for development stage companies, because even at these silver and gold prices, what their economic studies look like on paper, if you use the sensitivities anywhere close to where we're at, even lower prices, that $1 billion companies become $3 billion companies or $4 billion companies. When you look at the crop of companies that have pre-feasibility studies, feasibility studies, maybe even PEAs, and you look at the economics and you look at it in context of where we're at, even in a corrective mode, do you think that eventually some of the delta gets closed between the production margins and where the ounces in the ground are getting value? We've asked you this before, but it seems more startling when we put it in context with what's happened over the last 2 months.
It does. Yeah. I mean, these stocks have had these huge moves that they've got these rhino horns on their charts. They've gone up 3, 4, 5 times, and yet they're still trading at less than 150 ounces in the ground, and in some cases less than 100 ounces in the ground. And they're late stage, and they've already got their definitive feasibility study, or they've even financed, and they're close to construction, or they're close to getting their permits, or whatever. They're late stage, and these projects are going to be mined. They're still cheap, and right now a lot of them are showing these little fishing line sell-offs after these rhino horn moves. And those are the companies you want to look at. If you miss them, hey, these are the companies I want to start looking at to start nibbling, because they're still cheap. And basically that's what I've told my subscribers also, and basically told them in the form of what I'm doing myself. So, we're fortunate to be in several of these companies that have these rhino horn moves, and now they're starting to come off a little. And I've got a lot of new subscribers that have been waiting for entry points, and this is what's happening right now. And these entry points, they might last a week, they might last a month, they might last, 2 months, these sell-offs, but we just don't know how long this is going to last.
You're right, Dave. We don't know how long this correction is going to last, but it does seem like we are in a corrective period here. Huge volatility and some pretty big down days on some large volume. Look, I'm sure everyone's still sitting on some gains. It never feels good to see some of those gains evaporate, but hopefully some of you, all of our listeners, built up some cash, sold at least some of your gains so that you are sitting on some cash and you have locked in some of those gains. And when it turns, boy, oh boy, we'll be there to cover that move. But as of right now, I think more short-term defense is needed for portfolios. Again, Dave Erfle, founder and editor of the Junior Miner Junky. Click the link in the show notes to follow along with Dave's newsletter. Dave, thanks for your time. We'll chat with you next week.
Thanks, guys.